When a growth stock loses over half its value in a matter of months, the underlying math for investors changes. You are forced to decide if the market is accurately pricing a collapse or if the panic has created a specific window of opportunity. On the floor of the stock exchange, the current narrative suggests the fintech expansion has hit a ceiling. This sentiment has driven SoFi Technologies into a 55% decline from its recent highs. Despite the falling share price, the company's internal reports show they just completed their most profitable quarter to date. To understand this disconnect, we have to look at the structural shift occurring in their lending model and the specific risk factors that are keeping institutional money on the sidelines. While traditional banks manage the high overhead of physical branches and legacy systems, SoFi targeted high-income millennials and Gen Z with a purely digital ecosystem. This allowed them to scale their user base without the traditional costs of brick-and-mortar banking. The result is a stock price dictated by short-term market emotion, even as the company's long-term business metrics continue to move in the opposite direction. This chart tracks their growth through the first quarter, showing the addition of 1.1 million new members. That influx of users helped drive their adjusted revenue to a record $1.1 billion. In the software and fintech sectors, the Rule of 40 gauges the standard for elite performance. It combines growth and profit margins to see if a company is scaling efficiently. Crossing the 40% threshold is usually considered the mark of a high-performing tech company. SoFi reached a score of 72 on this scale, putting their operational efficiency well ahead of most of their peers in the Nasdaq. Much of this efficiency comes from their bank charter. By acting as a bank rather than a middleman, they fund loans using customer deposits. This lowers their cost of capital, as they no longer have to pay high interest rates to borrow lending power from larger institutions. This combination of record revenue and lower costs creates a high-margin system. It makes the stock's downward trend difficult to reconcile with actual earning power. If the growth numbers are reaching these levels, why is the stock market treating the company like a liability? Wall Street's concern is visible in the tech platform segment of this revenue breakdown. After the loss of a major client, revenue in this specific division dropped by 27%, raising questions about their ability to sell their software to other banks. The company also carries a massive portfolio of unsecured personal loans, making them highly sensitive to the broader economy. Even with a high-income borrower base, rising interest rates have pushed their annualized loan losses to 3.03%. Institutional short sellers are betting that a recession will cause those defaults to climb even higher. They are looking past current profits and focusing on how much debt these borrowers can actually handle if unemployment begins to rise. The stock's decline reflects a hedge against future economic instability. Investors are pricing in the possibility that a downturn could break the company's lending model before it reaches full scale. CEO Anthony Noto is attempting to neutralize that risk by moving the company toward a more stable financial structure. This capital-light model involves shifting away from high-risk lending and focusing on fee-based services like wealth management and retail access to IPOs. The goal is to generate revenue that doesn't require the company to put its own balance sheet at risk. If this transition works, management projects their earnings per share will grow by as much as 42% annually through 2028. Because of the current market panic, the stock is valued at a steep discount, trading at multiples usually reserved for slow-growth regional banks rather than tech platforms. History shows that some of the most significant market opportunities appear when a company's internal transformation is obscured by short-term macroeconomic fear. SoFi remains a battlefield. To some, it's a risky lender in a cooling economy. To others, a financial giant scaling through a difficult market. If the company meets its 2028 targets, the current share price will likely be seen as a significant entry point. However, any further decay in credit quality will ensure the road ahead remains volatile. Let us know your move in the comments. Are you buying the current sentiment or staying away from the volatility? Subscribe for more in-depth market analysis and institutional-grade deep dives. We'll see you in the next one.